History is being written on the charts right now. We are living through a financial moment that traders will talk about for decades. Look at the numbers. Gold is hovering near $4,140 an ounce. Silver is fighting a brutal war at $74. The markets are trembling. Welcome back to the channel. Today, we are not just looking at a chart. We are dissecting a global economic shift. We have a massive update to cover. Gold has staged a rebound that has shocked the bears, stopping dead in its tracks near $4,140. Why? Because fear has returned to the market. But while gold looks to the sky, silver is under heavy fire. The divergence is real. And the culprit? A crumbling US labor market and a Federal Reserve that is backed into a corner for 2026. In this deep dive special, we are going to analyze the 5,000-word story behind these charts. We will break down the ADP reports, the JOLTS data, and the technical levels that will define your next trade. Can gold actually recover and smash through the psychological barrier of $5,000? Or are we standing on the edge of a cliff? Grab your notepads. This is your ultimate breakdown of the gold and silver price forecast. Let's start with the headline that is driving everything: safe haven demand. To understand why gold is trading at $4,140, you have to understand the mood of the market. Right now, the sentiment is risk off. But what does that actually mean? In simple terms, the big money, the institutional investors, the hedge funds, the central banks, they are scared. When they get scared, they sell risky assets like tech stocks or emerging market currencies, and they park their cash in the bunker. That bunker is gold. The article we are analyzing today highlights a crucial rebound. Gold, XAU, USD, managed to stop a significant bearish trend. Just a few days ago, it looked like the floor might fall out. Why is this level significant? Because $4,140 isn't just a number. It represents a line in the sand. The market effectively said, "We are too worried about the global economy to let gold fall further." This rebound wasn't technical. It was emotional. It was driven by a need for safety. We are seeing a classic flight to quality. When the broader economy looks shaky, gold shines brightest. It has no counterparty risk. It cannot be printed by a central bank. And right now, with the prices hovering near historical highs, the market is voting with its wallet. Now, let's look at the engine powering this move: the Federal Reserve. The analysis points to a critical driver: interest rate cuts in 2026. Now, you might be asking, why does 2026 matter now? Markets are forward-looking machines. They don't price in what is happening today. They price in what they think will happen 12 to 24 months from now. The CME Group's FedWatch tool, the gold standard for predicting Fed moves, is flashing signals. Traders are now betting heavily that the Fed will deliver at least 2 rate cuts of 25 basis points each in 2026. Here is the mechanics of it. When interest rates are high, holding gold is expensive because gold doesn't pay you interest. It doesn't give you dividends. So, investors prefer bonds or savings accounts. But when interest rates are expected to fall, the opportunity cost of holding gold drops. The dollar weakens, and gold explodes upwards. The bets for these 2026 cuts have strengthened significantly. Why? Because the US dollar is losing its ground. The greenback has been under pressure, and this weakness is the direct fuel for gold's fire. A weaker dollar makes gold cheaper for foreign investors, increasing demand. It's a perfect storm. Fear is driving people to gold, and a cheaper dollar is making it easier for them to buy it. But why is the market so convinced that rates will drop? The answer lies in the data, and the data is ugly. We need to talk about the US labor market. For years, the US jobs market was unstoppable, but the recent reports signal a crack in the foundation. Let's break down the 3 key reports mentioned in our analysis. 1. The ADP report. This is the private sector payroll report. The market expected a decent number. Instead, we got a shock. Private sector jobs rose by just 22,000 in January. To put that in perspective, compare it to the revised 37,000 from the previous month. It missed market expectations by a mile. When businesses stop hiring, it's the first sign of a recession. 2. The JOLTS report. JOLTS stands for Job Openings and Labor Turnover Survey. This measures how many help wanted signs are in windows. The report revealed a drop to 6.542 million job openings, down from nearly 7 million previously. This is a massive contraction. It means companies are pulling back. They are tightening their belts. 3. Weekly jobless claims. This is the most real-time data we have. It measures how many people filed for unemployment benefits last week. The number jumped to 231,000. That is higher than the previous week and higher than forecasts. Connect the dots. Hiring is slowing. ADP. Job openings are disappearing. JOLTS. And more people are losing their jobs. Claims. This weak data is kryptonite for the US dollar. It tells the Fed, you cannot keep rates high or you will crash the economy. This is why the dollar is falling, and this is why gold is finding support. Bad news for the economy is becoming good news for gold prices. Gold is trading close to $4,940. But look at the structure. It recently failed to move back above the massive psychological barrier of $5,000. In technical analysis, round numbers like 5,000 are magnets. They act as psychological ceilings. The fact that gold couldn't break it keeps short-term pressure on the price. Let's zoom in on the candlesticks. The recent candles have small bodies and long wicks. What does that tell a trader? A long wick means rejection. It means buyers tried to push it up and sellers slapped it down, or vice versa. It shows indecision. The market is holding its breath. It is not showing strong selling, but it isn't showing a stampede of buying either. It's a standoff. The moving averages. Gold is currently trading below the 50-period exponential moving average, EMA, which sits near $4,150. This line is acting as a dynamic resistance. Every time the price tries to rally, it hits this moving ceiling and struggles. However, look further down. The 200 EMA is sitting at 4,395. This is the long-term trend indicator. Since the price is still well above this, the major uptrend is technically still intact, even if the short term is choppy. If you are trading this, you need specific coordinates. Let's map the battlefield. The downside protection, support. Gold is currently defending the $4,780 to $4,700 area. This isn't a random number. This zone aligns perfectly with the 38.2% Fibonacci retracement level at 4,155, calculated from the recent swing. It also coincides with a rising lower trend line from late January. If the bears take control, this is the fortress gold must defend. If $4,680 breaks, the floor opens up. The upside targets resistance. To the upside, the challenge is clear. Gold needs to break that $4,150 level, the 50 EMA. Momentum check, RSI. Look at the RSI, Relative Strength Index. It is hovering in the mid-40s. An RSI of 40-50 is no man's land. It suggests the price is stable but lacks clear momentum. We are waiting for a spark. Now, we must talk about the more volatile sibling, silver, XAG, USD. While gold is holding steady, silver is in a much more precarious position. Silver is trading around 72.40 on the 2-hour chart. To understand the pain here, you have to look at where it came from. The chart shows a pullback from a dizzying high of $120. That is a massive correction. Unlike gold, silver's recent recovery attempts look weak. The candles are forming lower highs. In a downtrend, a lower high is a sign that the bulls are running out of energy earlier and earlier. The bearish indicators. Silver is trading below both key moving averages. It is below the 50 EMA near $90. It is below the 200 EMA around $92. When the price is below both, specifically below the 200 EMA, the bias is overwhelmingly bearish. The death cross scenario is in play here. The old support level at 81.30 has now flipped. It has become resistance. This is a classic principle of technical analysis, polarity change. Once a floor is broken, it becomes a ceiling. Momentum. The RSI for silver is below 40. This is dangerous territory. It means sellers are in total control. They are not worn out yet. Usually, when RSI hits 30, we expect a bounce, but hovering below 40 just indicates relentless selling pressure. The bias only changes if silver breaks the falling trendline, but we are not there yet. Welcome to part 3. We have the news and we have the charts. Now, how do we make money? Based on the analysis, here are the specific trade ideas for the coming week. Scenario A. The gold buy, long position. We are looking for a breakout. Trigger. Do not buy yet. Wait for gold to break and hold above 4,150. That hold is key. We need a candle close. Target. If that happens, the next stop is 5,150. That's a roughly $200 move per ounce. Stop loss. To protect your capital, the stop goes below 4,780. This gives you a solid risk-to-reward ratio. Scenario B. The silver sell, short position. For silver, we are playing the trend, which is down. Trigger. Consider selling on rebounds. If silver rallies a bit but stays below 75s, that is your entry zone. Target. We are aiming for deep support. The first target is $64.40. If that breaks, we look at $60. Stop loss. Place your stop above $82. If it crosses $82, the bearish thesis is invalid. Risk warning. Remember, these markets are driven by data. If the Fed comes out tomorrow and changes their tone, these setups change. Always use stop losses. Stepping back from the daily charts, let's look at the horizon. Can gold recover $5,000? The answer lies in the 2026 forecast. If the US economy continues to produce weak labor data like the ADP and JOLTS reports we saw this week, the Fed will have no choice but to cut rates aggressively. A world with lower US interest rates is a world where the dollar is weak. And in a weak dollar world, a $5,000 gold price tag isn't just possible, it might be inevitable. However, silver remains the wild card. It has deeper targets near $64. This divergence suggests that while investors want safety, gold, they are worried about industrial demand, silver. Silver is partly an industrial metal. If the economy slows down, recession, factories need less silver. That is why silver is struggling while gold is holding up. To wrap up this massive analysis, gold is rebounding at $4,140, driven by risk-off fear and a weakening dollar. Silver is under pressure, technically bearish below key EMAs, targeting $64. The Fed is the puppet master, with 2026 rate cut expectations growing stronger due to weak jobs data. The strategy is patience. Buy gold on the breakout above $4,150 and sell silver on weak rallies below $75. The markets are speaking loud and clear. Volatility is back. The safe haven bid is real. Whether you are a bull or a bear, the next few weeks will be critical. Make sure you are subscribed to this channel. As soon as gold touches $4,150 or silver hits $64, we will be back with another update. Don't trade alone, trade informed. Hit that like button if you found value in this deep dive. Let me know in the comments. Do you think gold hits $5,000 before the end of the year? I'll see you in the next video. Stay safe and trade smart.